Look, I need you to understand something right now. What's happening in silver isn't just another technical pattern. This is the kind of setup that comes along maybe once every decade, and when it breaks, fortunes get made in a matter of weeks. I'm talking about a cup and handle formation that's been building for over 3 years, and we're now at that critical moment where the handle is complete and the breakout is staring us in the face. Let me paint the picture for you. Silver hit its recent high back in May 2021 at $30 an ounce. That was the euphoria moment, the peak of the post-pandemic commodity surge. Then came the correction. Silver pulled back, consolidated, and spent the next 2.5 years carving out this massive cup formation. The left side of the cup was that decline from $30 down to around $18 in September 2022. The bottom of the cup was that long base where silver just ground sideways, testing support, shaking out weak hands, building energy. Then the right side of the cup formed as silver climbed back up, reclaiming the $24 level, then $26, then pushing toward that $30 resistance again. Now here's where it gets interesting. Instead of just blasting through $30 and running, silver did exactly what you want to see in a textbook cup and handle. It pulled back slightly, forming this tight consolidation pattern just below the breakout level. That's your handle. And that handle has been compressing for the last several weeks, with lower highs and higher lows, creating this coiled spring of energy that's about to release. The technical setup is pristine. The cup took years to form, which means the base is solid. The handle is tight and controlled, not some wild, volatile mess. Volume has been declining during the handle formation, which is exactly what you want to see. It means sellers are exhausted. There's no supply coming to market. And when you look at the moving averages, silver is sitting right on top of its 50-day, with the 200-day providing support below. The MACD is curling up. The RSI is in that sweet spot around 55, not overbought, plenty of room to run. But let me tell you why this isn't just about pretty lines on a chart. The fundamentals backing this technical setup are absolutely explosive. Silver isn't just a precious metal anymore. It's become a critical industrial commodity that the world cannot function without. And we're running into a supply crisis that nobody's talking about. Start with solar panels. The solar industry is consuming silver at a rate that's accelerating every single year. Each solar panel requires about 20 grams of silver for the photovoltaic cells. Sounds small, right? But when you're installing hundreds of millions of panels globally, that adds up fast. In 2023, solar demand consumed roughly 140 million ounces of silver. This year, that number is projected to hit 160 million ounces. By 2030, some analysts are forecasting solar alone could consume 250 million ounces annually. That's nearly a third of total global silver production going into just one sector. Then you've got electric vehicles. Every EV uses significantly more silver than a traditional car. We're talking about silver in the electrical contacts, the charging infrastructure, the battery management systems. As the world transitions to electric transportation, silver demand from this sector is exploding. In 2020, automotive silver demand was around 55 million ounces. By 2025, it's expected to exceed 90 million ounces. That's a 64% increase in just 5 years. Add in 5G infrastructure, which requires silver for its superior conductivity in all those base stations and network equipment. Add in the electronics boom, the medical applications, the water purification systems. Industrial demand for silver is hitting record levels, and it's not slowing down. It's accelerating. Now here's the kicker. While demand is surging, supply is barely growing. Global silver mine production has been essentially flat for the last 5 years, hovering around 830 million ounces annually. Why? Because most silver isn't mined primarily for silver. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal prices are weak, or when those mines face operational issues, silver supply gets constrained, even if silver prices are rising. Mexico, the world's largest silver producer, has been dealing with regulatory challenges and community opposition to mining. Peru, the second largest producer, has faced similar issues plus political instability. These aren't problems that get solved overnight. They're structural constraints that limit how quickly supply can respond to rising demand. And then there's the inventory situation. The COMEX silver warehouses, where the paper silver market trades, have seen eligible inventory drop dramatically. We're talking about a decline from over 400 million ounces a few years ago to around 270 million ounces today. That's a 33% drop in available silver that can be delivered against futures contracts. When you've got a market where industrial users need physical metal and the warehouses are draining, that creates the conditions for a squeeze. Let me tell you a story that illustrates what's happening. Back in 2011, silver had its last major bull run, peaking at $49 an ounce. That move was driven primarily by investment demand. People were buying silver as an inflation hedge, as a monetary metal, as a speculation. It was a sentiment-driven rally, and when sentiment shifted, silver crashed back down. This time is fundamentally different. This isn't about speculation or sentiment. This is about actual physical demand from industries that cannot function without silver. You can't build a solar panel without silver. You can't manufacture an EV without silver. You can't deploy 5G without silver. This demand is structural, it's growing, and it's not going away. I was talking to a contact who works in the solar industry last month, and he told me something that should terrify anyone who's short silver. He said their company is now securing silver supply contracts 2 years in advance because they're worried about availability. 2 years. That's not normal. That's what happens when you see a supply crunch coming and you're desperate to lock in material before prices explode. And it's not just solar companies. I'm hearing similar stories from electronics manufacturers, from automotive suppliers, from industrial users across the board. They're all scrambling to secure silver supply, and they're willing to pay up to get it. Now, let's talk about what happens when this cup and handle breaks out. The measured move target, based on the depth of the cup, projects silver moving to around $38 to $40 an ounce. That's a 35 to 45% gain from current levels around $28. But here's what I think people are missing. That measured move is just the technical target. It doesn't account for what happens when you get a genuine supply squeeze in a market that's already tight. Look at what happened with palladium a few years ago. Palladium was trading around $500 an ounce in 2016. Then, automotive demand for catalytic converters surged. Supply couldn't keep up, and palladium went on a tear that took it to $3,000 an ounce by 2022. That's a 6x move, driven by industrial demand overwhelming supply. Silver has a similar setup, but with even more diverse industrial applications and a much larger investment market that could pile in once the breakout confirms. Here's another angle most people aren't considering: the gold to silver ratio. Historically, this ratio has averaged around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, with gold at $2,650 and silver at $28, that ratio is around 95 to 1. Silver is historically cheap relative to gold. If that ratio just reverts to its historical average while gold holds current levels, silver would need to trade at $44 an ounce. If gold continues higher, which looks likely given central bank buying and geopolitical tensions, silver could go even higher just from ratio reversion. And speaking of central banks, here's something fascinating. While central banks have been massive buyers of gold, adding over 1,000 tons to reserves in 2023, they're not buying silver. Why does that matter? Because it means the investment demand for silver is entirely from private investors, and that demand has been relatively muted compared to the 2011 peak. When silver breaks out and captures mainstream attention again, you could see a flood of investment demand on top of the already surging industrial demand. That's when things get really interesting. Quick aside here, because this is relevant if you're thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're concerned about dollar devaluation and want some hard asset protection in your portfolio. Anyway, back to this breakout setup. The technical trigger is clear. Silver needs to break and hold above $30 with conviction. Not just a quick spike that gets rejected, but a sustained move above that level with strong volume. When that happens, the cup and handle pattern confirms, and the measured move target comes into play. But here's what I'm watching for beyond just the price level. I want to see how silver behaves on any pullbacks after the breakout. In a genuine bull market, you get these sharp corrections that shake out weak hands. But the dips get bought aggressively, and the uptrend resumes. If silver breaks $30, pulls back to test it as support, and then bounces hard, that's your confirmation that the character of the market has changed. I also want to see the gold-silver ratio start compressing. If silver is outperforming gold on a percentage basis, that tells you the industrial demand story is taking over, and silver is being recognized as more than just gold's little brother. That's when you get the explosive moves. Now let's talk about the risks, because I'm not here to just pump sunshine. The biggest risk to this setup is a broader economic slowdown that crushes industrial demand. If we go into a deep recession and solar installations plummet, EV sales collapse, and electronics demand craters, that would undercut the fundamental thesis. Silver would still have its monetary metal characteristics, but it would lose that industrial demand driver that makes this setup so compelling. The other risk is a strong dollar. Silver, like most commodities, tends to move inversely to the dollar. If the dollar rallies hard, that creates headwinds for silver prices. But here's the thing. The dollar is facing its own structural challenges. The US is running massive fiscal deficits. The debt-to-GDP ratio is at levels we haven't seen since World War II, and there's a growing movement globally to reduce dollar dependence. The BRICS nations are actively working on alternative payment systems. Central banks are diversifying reserves away from dollars and into gold. The long-term dollar trend looks weak, which is supportive for precious metals. There's also the paper market manipulation argument that silver bugs have been making for years. The idea that large banks suppress silver prices through massive short positions in the futures market. I'm not going to dive deep into that rabbit hole, but I will say this. If there is artificial price suppression, and if physical demand continues to surge while supply stays constrained, eventually, something has to give. You can't suppress a market forever when the physical fundamentals are screaming higher. Let me give you some historical context. In 1979, silver was trading around $6 an ounce. Then the Hunt brothers started accumulating, industrial demand was strong, and inflation was raging. Silver went from $6 to $50 in less than 2 years. That's an 8x move. Now, I'm not saying we're going to see an 8x move from current levels, but it illustrates what's possible when you get a perfect storm of factors aligning. In 2008, during the financial crisis, silver crashed from $20 to $9 as everything sold off. But then, as central banks flooded the system with liquidity and investors sought inflation protection, silver rallied from $9 in 2008 to $49 in 2011. That's a 5x move in less than 3 years. Again, it shows the explosive potential when conditions align. The difference now is we have that industrial demand component that didn't exist to the same degree in previous bull markets. Solar was barely a thing in 2011. EVs were a niche market. 5G didn't exist. The industrial use case for silver has expanded dramatically, and that creates a floor under prices that didn't exist before. Here's another data point that should get your attention. Silver ETF holdings have been declining over the past year, dropping from around 1 billion ounces to about 950 million ounces. That's 50 million ounces of silver that left ETFs and went somewhere. Some of it probably went to industrial users who wanted to secure physical supply. Some of it might have gone to private vaults. But the point is, investment demand has been weak, and prices have still held up. That tells you the physical market is tight. When investment demand returns, and it will once silver breaks out and captures attention, you're going to see those ETF holdings start climbing again. That creates additional buying pressure on top of the industrial demand. It's a feedback loop that can drive prices much higher than the technical targets suggest. I want to talk about the mining stocks for a minute, because they're giving us another signal. Silver mining stocks have been quietly outperforming the metal itself over the past few months. The Global X Silver Miners ETF is up about 25% from its lows, while silver itself is up maybe 15%. That's unusual. Typically, the stocks lag the metal. When the stocks are leading, it often means smart money is positioning ahead of a move in the underlying commodity. The mining stocks are leveraged plays on silver prices, so if silver does break out and run to $35 or $40, you could see the miners double or triple. But here's the thing about mining stocks. They're also leveraged to the downside. If silver fails to break out and rolls over, the miners will get crushed, so they're not for the faint of heart. But for those who want maximum upside exposure to a silver breakout, The miners are where you get that leverage. Let me bring this back to the cup and handle pattern, because that's what this whole setup hinges on. The beauty of this pattern is its simplicity and its reliability. When you get a multi-year cup formation with a tight handle, and when that pattern forms in a market with strong fundamental drivers, the breakout success rate is extremely high. We're talking 70 to 80% of the time, these patterns deliver the measured move or better. The key is patience and discipline. You don't want to jump in before the breakout confirms. You don't want to chase it if it gaps up and gets extended. You want to wait for the clean break above $30. Let it prove itself for a few days, and then position accordingly. If you get a pullback to test $30 as support after the breakout, that's often the best entry point, because you have a clear risk level. If it breaks back below $30, you're wrong, and you get out. If it holds and bounces, you're in a confirmed uptrend with a favorable risk-reward. Now, I know some of you are thinking, but what if it doesn't break out? What if it fails at $30 again? That's a valid concern. If silver gets rejected at $30 and breaks down below the handle, the pattern fails, and you'd expect a move back down to test support around $24 or even $22. That would be painful for silver bulls, but it would also create another buying opportunity at lower levels, because the fundamental demand story isn't going away. But based on everything I'm seeing, the odds favor the breakout. The technical setup is textbook. The fundamentals are the strongest they've been in years. The supply-demand dynamics are tightening. The macro environment with inflation concerns and dollar weakness is supportive. All the pieces are in place. Here's what I'm watching in the coming weeks. First, I want to see silver hold above $27.50. That's the lower boundary of the handle. As long as it stays above that level, the pattern is intact. Second, I'm watching for a volume surge. When silver makes its move above $30, I want to see volume spike to at least 150% of the average daily volume. That confirms conviction behind the move. Third, I'm watching the gold-silver ratio. If it starts dropping below 90, that's a sign silver is gaining relative strength. I'm also watching the dollar index. If the dollar breaks below 100, that removes a major headwind for silver. And I'm watching the 10-year Treasury yield. If yields start falling, that's typically bullish for precious metals because it reduces the opportunity cost of holding non-yielding assets like silver. Let me give you a scenario of how this could play out. Silver breaks $30 in the next 2 to 3 weeks. It consolidates briefly around $31 to $32, then makes another leg higher to $35. At that point, mainstream financial media starts covering the move. Retail investors who missed the initial breakout start piling in. The ETFs see inflows. Mining stocks are up 50% to 100%. Silver pushes to $38, hits the measured move target, and then either consolidates or makes one more push to $40 before a meaningful correction. That's the bull case, and it's entirely plausible based on the setup. The bear case is that silver fails at $30, breaks down, and we get another year of consolidation. But even in that scenario, the long-term outlook remains bullish because the supply-demand fundamentals aren't changing. It would just delay the inevitable. Here's the bottom line. We're at a critical juncture in silver. The cup and handle pattern is 90% complete. The breakout level is clearly defined at $30. The fundamental backdrop is the strongest it's been in over a decade. The risk-reward is heavily skewed to the upside. This is the kind of setup that doesn't come along often, and when it does, you need to pay attention. I'm not saying mortgage your house and go all in on silver. I'm saying this deserves a serious look. If you've been waiting for a clear technical setup with strong fundamentals backing it, this is it. The next few weeks will tell us whether this pattern delivers, but all the ingredients are in place for something significant. Watch that $30 level. When it breaks with conviction, that's your signal. The cup and handle will be complete, and the measured move will be in play. Everything after that is about managing the position and letting the trend work. But the setup is here, right now, and it's about as good as it gets in the silver market. This is the moment. The pattern is formed. The fundamentals are aligned. The breakout is imminent. What you do with that information is up to you. But don't say you weren't warned when silver is trading at $40 and everyone's asking how they missed it. The chart is telling you the story. The fundamentals are confirming it. Now it's just a matter of execution.